there's some storm clouds on the horizon. And in fact, in our meeting this morning, we're setting up the show with Sean and Louise and me and Danielle and Shane and Jim. Kicking around the idea of maybe even getting, we had the Aiden sisters on some time ago, getting them back on. Because I don't do investment advice. I'm lousy at investment advice. Every time I try to make investment decisions, I lose money, which is why I don't think that we should have to. I don't think that 401ks and IRAs are a good idea. I think that, we should have pensions, or Social Security should just be strong enough that everybody can retire on a reasonable. If everybody retired and Social Security paid 30 or 40 grand a year, as is the neighborhood of the retirement benefits in the Scandinavian countries, for example, then, I think it would be fine. But in any case, a lot of us have a little bit or more than a little bit of money in the stock market or in something. And market, stocks, bonds, cash, gold, which I think should be a very small part of a portfolio. But it's been interesting to see the run on gold. What's been going on. It's been going down lately, but Louise and I were buying it when it was $230, $235 an ounce. I remember that. That was a decade and a half ago. But in any case, a bunch of stories in today's news. This is the Financial Times. I love the Financial Times because it's the rich people talking to the rich people, right? And because it's a British-owned newspaper, it's not owned by a billionaire like Rupert Murdoch, you tend to get the straight scoop, at least from the point of view of rich people talking to rich people. So Elaine Moore wrote a piece today for the Financial Times titled "Emerging Market Bond Sell-Off Gathers Pace." I'll just share two sentences from it with you. Speculation about economic revival in developed nations has led to the largest monthly sell-off in emerging market debt since the taper tantrum, raising concerns that the world is entering a phase of market turbulence. They did a study. It was very, it's something, anybody in Wall Street pretty much knows, but that if all you did was buy the entire Dow or the entire S&P, basically just a stock market index. In other words, you buy an exchange-traded fund, an ETF, that is equally invested in all of the companies listed on the Dow, or the top 100 companies, for example. If you buy in November and you sell in May, year after year after year after year, you will always beat the market. There's probably some exceptions to that, but I thought that was fascinating. I've never followed that advice. I thought it was fascinating. But here they're talking about, this summer. Investors, back to this article, investors have removed $4.4 billion from debt issued by countries in Africa, Latin America, Eastern Europe, and Asia, just in the space of a month. Then here's another piece in the Financial Times. Corporate debt market sees signal from M&A surge. Okay, we've talked about the mergers and acquisitions. In fact, we talked about it yesterday, how last week, how mergers and acquisitions activities do not produce anything of value. They do not produce wealth in an economy, but they do make the people at the very top very rich. And they lead to more layoffs. You got two companies. They both have their own bookkeeping departments. They merge into one, fire half the bookkeepers. They both have sales departments, fire half the salespeople. They both have, marketing departments, fire half, and that kind of thing. So mergers lead to layoffs, and yet we are at a peak of mergers. A testing May, again, this is Robin Wigglesworth writing in today's Financial Times, a testing May has turned into a torrid June for the U.S. corporate bond market, vaporizing returns and sending borrowing costs higher. Some analysts and money managers now believe the end of the market's golden era is getting closer. The latest evidence of the credit cycle losing some of its bloom is the surge in U.S. mergers and acquisitions. The value of deals announced last month jumped to $243 billion. That's for 1 month, according to Dealogic, smashing the previous records from May 2007 and January 2000. Well, what happened right after May 2007 and January 2000? The market crashed in both cases. Jack Flaherty, a bond manager at GAM, points out that rising M&A activity is a classic harbinger of poor times. He said that's when corporate spreads typically start to tick up. So look out, is all I'm saying. Look out.